Many of us have grown accustomed to ultra-low interest rates, but this was an unusual period. Rates have surged with inflation, and now many people are concerned about servicing their mortgage debt. And that's because they have to remortgage or take out a new mortgage. So in this video, we'll look at the UK and the US to see how high rates could go and when they'll start to fall. Now, don't forget, if you do like our content, then please do subscribe to our channel. It's completely free to do that. So let's look at mortgage rates and rates in general and when they'll start to fall again in a bit more detail. The situation at the moment is that risk-free rates are rising. What is a risk-free rate? Well, that's the rate at which the government can borrow because they don't default on their debt, at least not in developed markets. Then every other rate is layered on top of that interest rate with an extra bit of yield added on top. So for example, if you have very long duration debt, then you'll add something called a term spread. Now that compensates you for taking the extra volatility of holding fixed income debt for a long period of time and the volatility that goes with that. Some types of bond are very illiquid. They don't trade very often. And so if there's a crisis, it may take a long time to sell your bond. So there's a liquidity premium, which you can also harvest as a bond investor. Another spread you might add is for credit risk. So if you lend money to someone, they may not repay you. So you have to be compensated for that risk. And the bigger the risk, the bigger the spread. So if you're a very risky borrower or you're borrowing more as a percentage of your house value, you will have to pay a higher rate. And that's because of the credit risk. So generally what we see across the world is that the risk-free rate is rising, and that's pushing up the cost of borrowing for every other kind of borrowing. And we're also seeing some of the additional spreads on top of the risk-free rate increase as well, as credit risk has increased, for example. So here are the risk-free borrowing rates for a 10-year period for various governments around the world. And this is since the end of 2021. The general trend you can see is upwards for all countries, but there is a lot of variation between countries. Generally, countries which have the lowest levels of debt to GDP, or perhaps a much more careful spending plan where they try not to spend too much, there's a lot of fiscal carefulness, they tend to have the lowest yield. And that's a privilege. If you're careful with your debt, you get to borrow more cheaply. So for example, you can see that Germany has one of the lowest costs of borrowing, and that's been true for a very long time. Greece, on the other hand, but also Italy, has a fairly large cost of borrowing, and part of that is due to mistakes in the past as they've spent too much. In the case of the US, their yield is higher because their growth is higher, but also it prices in US inflation, which is very high at the moment. Now, the UK, until recently, was trading closer to Germany in terms of yield than the US, and its cost of borrowing was lower than the US at the 10-year point. However, after this mini-budget fiasco over the previous week, you can see that the UK has shifted very much into the camp alongside Italy and the US. If we look a bit further in time, you can see that the general trend in yields has been downwards. You can also see that yields are very strongly correlated. They tend to move up and down together. Now, sometimes you get a single country's yield blowing out when its fiscal irresponsibility makes its cost of borrowing higher, as happened with Italy, but also other peripheral countries during the European sovereign debt crisis. And that's also happened to the UK over the last week. So as we saw, the overall cost of borrowing for things like mortgages will have the risk-free rate plus additional spreads piled on top. So here you can see that for the UK. What I've shown here is two mortgage borrowing rates for a 2-year fixed period. So this is either borrowing 60% of the value of the house or 95%. Now the credit risk, the loss given default, is greater for a 95% loan-to-value mortgage. And that's why the rate you'd pay for that is always higher than it would be for a 60% loan-to-value mortgage. So that's largely due to that credit risk and the loss given a default. The two other rates you can see here are risk-free rates. One of them is the bank rate, the policy rate set by the Bank of England, and the other one is the 5-year borrowing rate for UK government bonds. But generally, the pattern we've seen over the last year is bank rate has surged upwards with inflation as the Bank of England tries to combat above 10% inflation. and all the other rates have increased along with that. And that, of course, has included mortgages. But notice the contrast with the US market, where instead of fixing for 2 years or 5 years, you can fix for a 30-year period. And that means that the appropriate rate for comparison, the risk-free rate, would be the 30-year Treasury rate, not one of those short-term rates that we saw for the UK. So the short-term rate will be driven very much by the central bank's policy rate, which we call bank rate in the UK, whereas the US mortgage rate, the 30-year rate, will be driven very much by the long end of the curve, which in turn is driven by growth and inflation expectations. Now that is going to have a bearing when we come to actually try to forecast where we could head for rates later in the video. Before I go on to talk about where rates are headed, let me just quickly mention our membership, where you get access to lots of goodies, such as the ability to ask me a question whenever you like on Slack, and you can talk to other members of the community. It's a very friendly environment, and you get access to members-only videos. To learn more about that, just click on the link beside me and in the description beneath me. So why are rates rising so much? Well, in the US, remember, we're talking about the long end of the curve, and that's driven by US nominal GDP growth. So here I've plotted US nominal GDP growth in blue, going back to the 60s, and I've also got the red line, which is the US 10-year yield. And you can see that the two are related to each other. They both go up and down in sync. There's been a massive divergence recently as inflation has surged, but many people expect that GDP will come down. That's not because real growth is high, it's because inflation is extremely high at the moment. The UK has also lost credibility in international markets with its latest budget, or the fiscal shock as the FT describes it here. But if you speak to many institutional fund managers, who are the people who buy a lot of UK debt, they say that they're more reluctant to buy it. In other words, they have to be paid a higher yield to make UK debt attractive. So here, for example, is Christian Kopf, who works for a large European fund manager, who says we're going to be much more reluctant to put on big trades in gilts. And the reason he gives for that is that it's become an unpredictable market with populist policies. And even if the Bank of England's fixed the plumbing, remember the Bank of England bought huge amounts of long duration gilts to try and get yields to come down, you're still left with an inconsistent fiscal policy. So the government's spending plans are inflationary, and they're pulling in the opposite direction of the Bank of England, which is desperately trying to get inflation under control. And as a consequence, the Bank of England is going to have to be that much more aggressive by raising interest rates more in order to get inflation under control. So there's this tug of war between fiscal policy from the government versus monetary policy from the central bank. Now let's look at where UK rates are going. Well, over the course of 2022, they've been going up and doing so very quickly. So for example, if you're fixing for a 2-year period, the rate has almost tripled from just over 2% to just under 6%. And for a 5-year fix, it's gone from just under 3 to just above 5. So a series of very rapid increases. And the consequence for debt servicing costs has been huge. So for example, with a 200k mortgage, if you've gone from 2% to 6% when you remortgage, the cost of your monthly payments has gone from just over £800 to just under 1,300. Now that's going to make many houses unattainable because people simply won't be able to borrow enough to buy them. So that would almost certainly have a cooling effect on UK house prices. Also, it means that people might lose their houses if they can't afford to make the payments every month. Now, if you do fix your mortgage, say for a 2-year period, the bank from which you've borrowed the money will actually lay off the risk with an interest rate derivative called an interest rate swap. So that's what determines the rate that you pay. It's the swap rate. And in the case of the UK, swap rates have recently surged to just under 6%. And that's why all of these products had to be taken off the market and then repriced at much higher rates. And we haven't seen such high swap rates since 2008. Now, this swap rate will in turn be linked to the cost of UK borrowing. So it would be the UK 2-year gilt rate plus a spread for additional risk. So all of these rates will move up together, and as bank rate and gilt borrowing rates increase, so will the swap rate and so will the mortgage rates that we have in the UK. Now, one factor, as we saw previously, which is pushing up UK borrowing rates, is the antagonism between the fiscal policy of the government, which is inflationary. That's what the tax cuts have essentially done, create more inflation. So the Bank of England has to be more aggressive with its monetary policy and raise interest rates more. So this is the pre-budget forecast for the bank rate from NISA, the National Institute for Economic and Social Research. And you can see that its forecast has increased quite significantly by 2 percentage points. Instead of being at 3% in 2023, the bank rate, it's now going to be at just under 5% in Q3 of 2023. What does that mean for mortgage rates? Well, if we layer them on top of this risk-free rate, well, we could very simplistically say that we go from 0% to 5%, so that's a 5% difference. So mortgages would also go up by that amount. So instead of a 2% rate, we'd expect to pay a 7% rate. And that would be at the peak of the market in Q3 of 2023. Then rates gradually fall back to 3%, and that would mean that the 2-year fixed rate would fall back to about 5%. But that won't happen till after 2026. So what we have is a pattern of initial pain as the Bank of England fights inflation, and then if it succeeds and gets inflation under control, rates should come back down to 3%. So not to where they were before, but not as high as they are when they peak. Now, the government has done a partial U-turn by removing the additional rate of tax in its fiscal plan. However, as the economist Paul Johnson says, the effect is going to be negligible on the cost of their plan. So instead of costing 45 billion, it's going to cost 43 billion. And consequently, the effect on the bank rate will also be negligible. What really is inflationary are those other tax cuts for companies, but also for individuals. Now let's look at where US rates are going. Recall that this is usually very long dated. It's a 30-year rate, and that means it'll be driven by nominal GDP. So if we knew where nominal GDP was going, we could have a stab at working out the 30-year rate. Who better than the Federal Open Markets Committee to have a guess at where nominal GDP will be? So these are their dot plots from their latest meeting, and they have a forecast for GDP. This is for 2022 up to 2025 and for the longer run. And they also have a guess for where PCE inflation is going to be. So if we add the two, we'll get a rough estimate of nominal GDP. And if we plot nominal GDP, that's what's on the x-axis here, versus the 30-year mortgage rate, we get a very fuzzy relationship between the two. But what it does mean is we can estimate what the US 30-year mortgage rate would be given the estimate for nominal GDP. So here are the two forecasts we're interested in, and that's the GDP forecast, the real GDP forecast, and the PCE inflation number. Now, if we add the two, we'll get the nominal GDP growth rate roughly. So in 2022, it's 0.2 plus 5.4, which will give us nominal GDP of 5.6%. And if we put that into our very basic model, it'll give us a 30-year mortgage rate of 7.5%. So that'll be the high point of US mortgage rates. Then what we see is that real GDP increases in 2023, but inflation decreases more. And that means nominal GDP falls to 4% and stays there until 2024, and then essentially goes to the long-run average in 2025, which is 3.8%. So the mortgage rate will fall to 5.8. I think that's easier to understand if we see it on a graph. Here we've got the US mortgage rate going back to 2016 in red. Recently it's seen this huge surge to 6.7%, and according to our forecast, it would peak at 7.5%. Then in 2024 it would fall back to 5.9 and gradually fall back to its long-term average, which is 5.8. I've also shown here the Fed funds rate, which is set to peak considerably higher than it is right now. Then it's going to peak in 2024 and fall back to its long-run average by 2026. In conclusion then, the really bad news is that the era of free money is over. So we're just going to have to live with higher rates. Also, we're going to see rates probably peak higher than they are now. But there is a bit of light at the end of the tunnel, which is that if we return to normal inflation and growth, then rates will fall from those peak values. However, they won't fall to where they were in the era of free money. And that is going to have an effect on the value of equity, which will have to re-rate lower, And of course, it'll have an effect on the property market because the cost of borrowing will be higher. So while UK mortgage rates and US rates are driven by very different parts of the curve, they undergo a very similar pattern in the years ahead, which is to peak and then gradually fall back. However, they're not going to fall back to the rates they were at in the era of free money, unfortunately. Now, don't forget our offer of membership. You can learn about that on PensionCraft.com, and you get access to lots of goodies. We'd love to have you as part of our community. And if you want to learn more about that, there'll be a link beside me and in the description beneath me. And as always, thank you for listening.